Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how are you?
I'm doing well. How are you today, Will?
Doing all right, doing all right. Although your voice sounds a little bit hoarse. You didn't throw it out yelling at the TV on Sunday, did you?
I did not. I would have loved to have gone to the game, but always nice to have a Super Bowl party with some friends and this year was a little strange. I was with a whole bunch of 49ers fans, and so it's weird being with a bunch of people that are actively cheering against your team. So, but it was fun.
Well, for those of you who don't know, Ben, obviously you're a big Kansas City Chiefs fan. So once again, congratulations on that. And, another big win for the state of Missouri at the very least. So giving a quick rundown on the recap of where we sit right now, we continue to see a lot of sideways action within the commodity markets. So that March 24 corn contract down 10 cents at 4.32. March soybeans down 3 cents at 11.93. Soybean oil cents per pound for March up 2.11 cents at 47.44. Soybean meal by the short ton was down 14.60, so a pretty big drop there, down to 346.50, and then that March contract for wheat was up 3 cents on the week at 5.93, and then once again the crude oil contract for April up $4.17 at 77.01. So Ben, a lot of sideways movement, but a pretty good drop for that soybean meal contract.
Yeah, I think we're going to continue to see soybean meal prices fall. This is a change of fundamentals from where we were not that long ago, 6 months ago, maybe 8 months ago. We kept talking about getting close to $400 or $500 soybean meal contracts per short ton, and now we continue to see that contract slide. And I think it's just going to continue. Soybean crush here in the United States has been strong. We've produced a lot of soybean meal, but the market is now starting to price in a very large Argentina soybean crop. Argentina is the world's largest exporter of soybean meal. And so the expectation is that those products are going to start hitting the export markets in the next couple of weeks. And that's what's leading to some of that deterioration there in the soybean meal contract.
So, Ben, today we have some reports to digest and talk about. One of the things that came out, the consumer price index was higher than, I guess, expectations there for the month at 3.1% year over year. Expectations were just under 3%. So it doesn't seem like necessarily a big difference, but those small changes mean a massive ripple effect, when you look at how big that swing really is. So what does this mean, that 0.2 difference mean for what we're seeing out of consumers?
I sound like a broken record, but I continue to say that this last percentage point that the Federal Reserve or the Open Market Committee wants to get inflation down to 2%. We're at 3%. It's going to be hard to get down to 2%. It's going to be painful. They're going to have to be very disciplined, and I've continued to beat that drum. I'll give you an indication of just maybe the change in sentiment. So there is this thing called the Fed Funds Watch tool. It's probabilities of all sorts of traders, hundreds and thousands of traders that are looking at their expectations of interest rate cuts in the year ahead. Not that long ago, just back in the middle of January, there was a 70% probability that we would see the first interest rate cut come at the upcoming March meeting. That probability has now reduced all the way down to 6.5% of a rate cut in the March meeting. Likewise, the May meeting, which would be the next meeting, there is no April meeting this year. The May meeting also has a favorable rating, or the probability is that the Federal Reserve will not make cuts. And so now the first cut, a 51% chance of a cut, is now coming in June. And so to answer your question, these economic data continue to come in hot. They continue to come in strong. They continue to suggest that the U.S. economy is rolling along, both in terms of the jobs market, and it's trickling into higher inflation. And so that's the one thing that I keep telling people is yes, the economy is hard for those that are living pay to paycheck and paycheck because of the inflation component. And that's what the Federal Reserve is trying to control. But when we look at the broader economy, the economy is continuing to roll along, and we haven't seen a lot of slowdown yet. This maybe signals that inflation returns at the back end of this year. that could possibly mean some higher commodity prices, that we start to see inflation figure into commodity prices. Now, what Ben Brown did not say is that I did not say we were getting back to $7 corn at the back end of this year. But certainly, we've been in a decommodity or deflation commodity trend. Those prices you just read off have consistently been moving lower, and we could see a little bit stronger of a rally in commodity prices in the back end of this year due to inflation returning. So I sound like a broken record. How many times have I said that, Will?
I think it's a weekly occurrence, but I don't think we can stress enough how, much of a big deal this is when you look at how the Fed might behave. Because you see that about 1% difference between, that 2 to 3% where they're trying to get inflation knocked down to 2%. And it almost seems like getting that last percentage point takes about as much work to get to where we are now, or the change that we've gotten to where we've gotten now. Almost like, charging a battery where 0 to 80 takes X amount of time, and then 80 to 100 takes the exact same amount of time. It's that same kind of process.
Sure. Yeah.
But Ben, some other news, some other reports that we get to look at today. The February supply and demand reports coming out from USDA were released last week. And starting with U.S. carryout, Ben, that came out on the upper end of the ranges, the estimates for corn, soybeans, and wheat. As we look at that, and then, that was also kind of reflected looking at the global picture as well. Where do we stand when we see all these estimates coming out near the upper end of these ranges?
Sure. So I'm going to start with soybeans there because I think soybeans is the most interesting of the three commodities this month. And by the way, February's WASDE report has traditionally not been an overly, what's the word I'm looking for, surprising report. We haven't started planting here in the United States. South America soybean production is fully in swing. We have a pretty good idea. So it's usually not a huge surprise, but this year we did see some surprises, namely in that soybean complex. So I'll start with USDA or the US carryout for our old crop, coming in at 315 million bushels. That was up from 280 million bushels, or up 45 million bushels from the 280 last month. That was all. That increase was all for a reduction in exports. And that was the other surprise in this report. USDA did not lower our South America, namely Brazil, soybean production as much as what the market was anticipating, reducing it 1 million metric ton to 156 million metric tons. But that was still almost 3 million metric tons above where the trade thought USDA would be. So recognizing that large soybean crop in South America is going to impact exports of soybeans from the United States, USDA went ahead and lowered U.S. soybean exports this month. They could have, in my opinion, offset some of that reduction with an increase in domestic soybean use, but they chose to wait a while. I still think that's coming. I think that's coming down the line. But for now, growing supplies up over 300 million bushels in that soybean thing. I think you saw the market react very quickly. My last point here, Will, is I think we saw the market react very quickly to both of those numbers: a larger than expected soybean carryout for the U.S. and then larger production out of South America, both for this year and last year. USDA revised both of Brazil's production years up. However, the market quickly within the day corrected to trade back to normal, reducing some of those big losses. And I think the reason is the expectation that USDA will eventually have to make more cuts. And so a little bit of speculative trading, I think, happening in the markets the day this report was released.
Well, and Ben, also looking at South American production and the estimates that we saw around that, really Argentina, both for corn and soybeans, came in at the lower ends of the ranges provided, and then Brazil kind of smacked in the middle with those. But still looking at strong numbers from both of those countries. How does that play a role in maybe the behavior of the market moving forward when we look at global trade and look at the United States' place within that picture?
Yeah, so I don't know if this is the question you just asked me, but this is how I'm choosing to answer it. There's always, every year, it seems like there's frustration that USDA is not reducing the South American crop as fast as what market attendees or market participants would like to see. Earlier in the day, Thursday, the Brazilian version of USDA came out with a sub 150 million metric ton number. And so there was certainly optimism within the market that USDA would reduce their soybean number even more than what they did. Again, they only reduced that soybean number 1 million metric tons. And so, this has been kind of a consistent trend the last couple of years is when we have these shortfalls and droughts in South America, why isn't USDA reacting quicker? I'll answer it in a simple way of saying that historically USDA has actually been pretty good. They maybe have not started the deterioration as fast as what some of the other agencies and private estimates have done, right? But they tend to be actually pretty close to what the final number ends up being. Again, they're slower to adjust, but they don't like going back later and then adding carry out to those markets. They would rather just reduce and not add. And I know that creates a lot of frustration on a lot of market participants from the standpoint of like, well, they're artificially keeping the market a little bit lower than what it should be. I don't think that's what USDA, but who am I? I'm Ben Brown, but that's not my estimate of what USDA is doing in this case. And I'm certainly not going to bash them, because as I mentioned, like they actually have a pretty good track record here of they start slower, but they end up getting pretty close to the final number without having to reverse course.
Well, and it kind of comes down to what would you rather have? Would you rather have USDA as an agency swinging these numbers wildly and causing, a big ruckus, and then at the end of the day ending up in the same place that they would, kind of gradually and, in a level-headed way trying to track down the estimates?
Yeah, so I think I do think USDA is going to lower South American production for both corn and soybeans a little bit more, especially for Brazil. We saw them lower Brazilian corn production 3 million metric tons. We saw them reduce that soybean number again 1 million metric tons. I do think we've got a little bit more deterioration in those markets. We're getting close to having a good idea on the soybean. The corn's just now getting planted, and so we've got a long way to go on corn, but. I do think that's where the market optimism returned back after the report release on Thursday was, hey, USDA will probably continue to reduce the South American production, so there's no need to oversell here.
It becomes some opportunity maybe for some US rally.
Sure. Well, and you saw that in those prices that you reported, right? So the fact that soybeans, let's look at March soybeans, down 3 cents week over week. That's coming in the same exact week where the soybean carryout in the United States exceeded all trade estimates, right? Like that should have been very bearish to the market. And it was initially, but the market then started to realize, hey, USDA will make some more adjustments in the months ahead. So,
no. Well, Ben, looking forward to what other reports farmers and ranchers should be paying attention to. What should they be paying attention to?
Yeah, it's a fun week, actually. So this, let's start with our reports that come out. So we do have on Thursday of this week, we do have that January NOPA crush report. Again, we've seen very strong crush for soybeans here in the United States. We'll get another chance to look at that. This one could be a little bit softer than what we've seen. Again, January was a cold month and that impacted ethanol, and we anticipate that to impact soybean crush as well. So maybe we don't get a record soybean crush in the month of January like what we have been seeing these last couple of months. But that's not to say that the industry has turned softer, right? Like it was very cold during January. The thing that's interesting and unique about this week, though, Will, is USDA is having their Ag Outlook Forum. This is the 100th Agriculture Outlook Forum. This is when USDA publicly releases their first baselines for the new crop, 2024 production. The markets will react to this. And the big thing here is the yield. The trend yield that they release this week will be the trend yield, or the yield that shows up on those first new crop balance sheets in May.
Well, there you go. So a big thing to watch for any interested market speculators. Ben, it's always a pleasure having your knowledge and information on the program. Viewers and listeners, if you'd like to learn more about us and what we do, or our sister program, the Weekly Livestock Market Update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.